We're here to make sense of those really dense financial reports, especially when you've got tricky stuff like hyperinflation going on.
Exactly. Makes things much harder to read straight.
Today, we're tackling Çan2, that's Çan2, and their Q3 2025 financials.
And yeah, like you said, we absolutely have to flag the hyperinflation issue right at the top. We're talking Turkey, so every number we mention, it's been adjusted using TMS 29.
Right, the hyperinflation standard. It's the only way to get a real comparison year on year, but it definitely adds a layer of complexity.
No doubt.
So our goal today really is for you, the individual investor. We want to cut through that complexity. Is Çan2, basically a struggling Turkish power company, or is it something else now, maybe transforming with these big international moves?
That's the core question. Let's start with the basics. Who are they? Çan2 is a major name in Turkish energy, HQ in Istanbul, but the power plant itself, the main operation, is down in Çanakkale.
And their core business.
Electricity generation. Specifically from domestic coal. They got about 340 megawatts installed capacity.
And the key thing, their strategic edge, really, is that they use this high-quality local lignite coal.
Exactly. That local supply gives them a bit of a buffer against the wild swings you see in international coal prices. It's a definite cost advantage compared to competitors who have to import coal.
So they've got their own fuel source nearby.
Pretty much. They own mining subsidiaries locally, like Çan2 Trakya and Yel Energy, fully owned. So it's integrated, but, and this is a big but, the company's identity is shifting, and fast.
You mean the Venezuela deal?
Yeah, April 2024. They bought 65% stakes in Daenerys Pumping Services. That pulls them into, investment projects and oil extraction services over Venezuela.
So not just a Turkish power plant anymore, they're now playing in international oil services too.
Right. It's a diversification play, a big one.
Okay, what about the structure? Who owns Çan2?
The main shareholder is still Odas Electric, holding around 29%. But the public float is actually pretty big, over 70%. So lots of shares are out there on the market.
And governance. Anything stand out on the board or management?
Well, two things jump out when you look at the report. First, the board have 5 members, and the key management team listed also has 5 people.
Okay.
And there are no women listed in either group, 0 out of 10. For investors focused on ESG, environmental, social governance factors, that's a data point they'll notice.
Definitely something to be aware of. What was the second thing?
Executive pay. Total compensation for the board and senior execs for just the first 9 months of 2025. It was almost 68 million Turkish lira.
68 million for 9 months. How does that compare?
Well, compare it to the full year 2024. The total then was about 63 million TL. So a pretty significant jump in pay during a period where, as we'll see, the company's financials were under considerable stress.
Interesting timing. And operationally, how big are they? Staff numbers?
They employ just under 700 people, 698 as of the report date. Standard labor law compliance, but no collective bargaining agreement in place.
Okay. Now, to really get Çan2's performance, we need to look at the wider Turkish energy market, right? What's happening there?
It's changing fast. Total installed power capacity in Turkey went up over 6% in the first 9 months of 25. That's a lot of new power online.
Where's that growth coming from? Still coal and gas?
Not really the main drivers. The big story is renewables, especially solar massive jump, over 5,000 megawatts added. Wind also grew significantly. Renewables overall grew nearly 11%.
So more competition, especially from cheaper renewable sources. How's that affecting Çan2?
You can see the pressure. Despite all that market growth, Çan2's actual electricity production decreased slightly compared to the same period last year, about 12,279 gigawatt hours versus 4,404.
So they're losing ground or maybe facing operational issues?
Could be a mix of both. Stiffer competition, maybe maintenance, maybe lower utilization rates. The report doesn't specify exactly why, but the trend is down.
What about the prices they're getting for their electricity?
Okay, this is key. The wholesale price, the PTF, it went up 17% in Turkish lira terms. Sounds okay, right?
On the surface, yeah.
But, and this is crucial for anyone thinking in, say, US dollars. Because of the lira's depreciation, that same price actually fell almost 2% in dollar terms, down to about $66 per megawatt hour.
Ouch. So the currency move is wiping out the local price gains in real terms.
Pretty much eroding the value for international comparisons or for servicing any foreign currency debt, for example.
And their input costs, coal, etc.
Bit of a mixed bag there. International coal prices, the API2 index, actually dropped quite a bit, down over 21% in dollar terms. That helps lower the overall market price ceiling, maybe giving Çan2 some breathing room.
Okay, a potential tailwind.
But then you have natural gas. The regulated biotash tariff for gas jumped 25% in lira. That really hurts their competitors who rely on gas-fired plants.
Ah, so that makes Canty's domestic coal look relatively more cost competitive within Turkey.
Exactly. It's a definite plus for their specific operating model in the current environment.
Right, so with all that context, let's get into the tough part. The income statement for the first 9 months of 2025. You mentioned financial stress.
Yeah, brace yourself. The numbers aren't pretty. Revenue or hasalat dropped quite significantly in real inflation-adjusted terms. Fell from 5.5 billion lira in 9M 2024 down to about 4.6 billion in 9M 2025.
That's nearly a billion lira gone from the top line.
And it gets worse for further down. Gross profit, it basically collapsed. Went from almost 1.4 billion lira profit down to just 328 million.
Wow, that's a huge hit to the margin. Why so steep? Did costs shoot up?
That's the really telling part. Revenue went down, right?
Yeah.
But the cost of sales, it actually crept up slightly in real terms, from 4.17 billion to 4.23 billion lira.
Wait, costs went up even with lower production and revenue? How does that happen?
It points towards inflexible costs, things like maybe long-term supply contracts or high fixed costs like labor or maintenance that they couldn't cut back quickly even when the market turned against them. They couldn't adapt fast enough.
And that inflexibility just crushed the operating profit.
Absolutely demolished it. The core operating profit, Isas Fatiyet Kari, it flipped completely. From a 362 million lira profit in the first 9 months of 24 to a 367 million lira loss in 25.
So the core business, just generating and selling power, is now losing money before you even factor in interest or taxes.
Correct. The day-to-day operation turned unprofitable.
So the bottom line, the net profit or loss must be pretty bad.
It's stark. The net loss widened significantly. They lost 1.16 billion lira in 9M 2024. This year, 9M 2025, a 3.0 billion lira loss, almost triple the loss.
3 billion lira loss. Wow. What's driving that huge number besides the operating loss?
Two main culprits stand out in the report. First, financing expenses. They ballooned to about 1.3 billion lira. That tells you they're carrying a lot of debt, likely at high interest rates. Borrowing is expensive in Turkey right now.
Okay, high debt costs. What's the second factor?
That hyperinflation accounting again, TMS 29. They reported what's called net monetary position losses of around 710 million lira.
Monetary losses. What does that mean for an investor? Did they lose cash?
Not exactly like cash disappearing. It means they held assets like cash or maybe receivables owed to them, things whose value is fixed in lira terms. And because of high inflation, the purchasing power of that lira just evaporated over the period. TMS 29 forces them to book that economic loss.
So the value of their cash and near cash holdings effectively shrank because of inflation.
Precisely. So you've got the core business losing money, massive interest payments dragging them down, and inflation eating away at the value of their monetary assets. It's a tough combination.
Okay, that's a painful income statement. Let's switch to the balance sheet and cash flow. Maybe there are signs of strength there. You mentioned liquidity earlier.
Yeah, surprisingly, cash itself actually went up. Cash and equivalents rose quite a bit to 647 million lira from under 200 million at the start of the year.
How did they manage that with such big losses?
A big part of it looks like really strong working capital management. Remember those receivables I mentioned? Trade receivables from unrelated parties dropped massively, from 2.3 billion lira down to just 721 million.
So they collected a lot of money owed to them. That's definitely a positive.
A major positive. Shows good control over collections. Inventory also went up, hitting 2.4 billion lira, mostly stored coal.
Anything else significant on the balance sheet? Liabilities?
Big shift there. Total short-term debt, things due within a year, basically got cut in half.
Halved. How?
The key move was in deferred income. Ertlen Mishka Liralar. A huge chunk, over 2 billion lira, got reclassified from short-term to long-term.
Deferred income. What's that usually related to?
In this case, the report links it directly to the new Dineria subsidiary in Venezuela. It suggests they've received funds or recognized assets related to that venture, but the associated revenue or benefit will be realized over several years, hence moving the liability to long-term.
Ah, so it reflects the accounting for that big international investment.
Exactly. It's a structural change tied to the new business line.
Okay, now for maybe the most critical piece, cash flow. How did the actual cash generated from running the business hold up?
This is where it gets alarming and where the accounting gets tricky again. Operational cash flow saw a complete reversal. In the first 9 months of 2024, they reported a huge inflow from operations 7.5 billion lira.
7.5 billion inflow. That sounds amazing.
It does, but hold on. In the first 9 months of 2025, that flipped to a 58 million lira outflow.
Outflow from 7.5 billion inflow to a 58 million outflow. How is that even possible? What happened?
This is where understanding the TMS 29 impact is vital. That massive 7.5 billion inflow last year. It included a huge non-cash adjustment for monetary gains from prior periods' hyperinflation effects, about 4.2 billion lira.
So almost half of that inflow wasn't real cash generated that year. It was an accounting adjustment.
Exactly. It inflated the 2024 number massively. If you mentally adjust for that, you see the underlying trend more clearly. And the 2025 result, the outflow, shows the real picture now. The cash cost of running the business is currently higher than the cash they're bringing in from sales.
That's the most critical number then. The business is burning cash operationally.
On a net basis for this period, yes.
Yeah.
But there's a counterpoint in the investment cash flow section.
Okay, what happened there?
Another huge reversal, but in the opposite direction. Investment activities generated a 1.15 billion lira inflow this year. Compare that to last year, where they had a massive outflow of almost 7 billion lira.
So they went from spending huge amounts on investments to actually generating cash from investment activities.
How?
Selling assets.
It looks like movement related to tangible fixed assets is the main driver. The report details suggest maybe asset disposals, or perhaps transfers related to the restructuring or the Venezuelan deal. It seems less about pouring new money into building things and more about maybe recycling capital from existing assets.
Interesting. So possibly selling off some things to fund other areas or just shore up cash.
That could be the strategy, yeah.
Yeah.
Restructuring the asset base. It fits the narrative of funding the denarius venture or managing liquidity during this tough operating period.
And finally, what did all this do to the company's equity, its net worth?
Equity decreased slightly, down to about 26.5 billion lira. That big net loss directly eats into the equity base. And consequently, the loss per share got worse too.
Okay, let's try to pull this all together. What's the big picture story here?
Well, Çan2 is definitely facing a tough battle on the home front. Their main power business is squeezed by rising real costs, tough competition from renewables, and prices that aren't keeping up in dollar terms.
And the financial structure is amplifying the pain.
Hugely. High debt costs and those big hyperinflation accounting losses are turning an operating loss into a massive net loss. The operational cash burn is a major red flag.
But it's not all negative, right?
No, definitely not. They showed excellent management of receivables, which boosted their cash position significantly. They're actively restructuring assets and liabilities, likely linked to this major strategic bet on the Venezuelan oil services market via denarius.
So they're trying to navigate the storm while placing a big bet on diversification. What about the future outlook? Dividends, maybe?
Their official policy mentions aiming for a 50% payout of free cash flow, but, and this is key, it's not mandatory. Given the huge net loss, the negative operational cash flow, and the clear focus on investing in denarius, you'd have to say dividends look extremely unlikely anytime soon.
Right, makes sense. Survival and investment probably come first.
Absolutely.
So this leaves us with a final thought for you, the listener. Çan2 clearly owns valuable domestic assets. That power plant using cheap local coal is still significant. But they've also made this incredibly bold, maybe risky, move into international oil services.
The critical question isn't just, is the stock cheap? It's more about risk and timing. Can they manage these crippling financing costs and the domestic operational losses long enough?
Long enough for that big Venezuelan bet, the denarius investment, to potentially start paying off and maybe stabilize the whole company? Or will the problems at home drain their resources before the diversification strategy can mature?
It's a classic high-stakes scenario.
Yeah.
You can see the tension right there in these key three numbers, the operational pain versus the strategic pivot. We hope this deep dive has given you some clarity on how to weigh those factors.
Definitely a complex one. If you found this analysis useful, please do give us a like, subscribe to the deep dive for more content like this, and share it with anyone else trying to navigate these markets.
Thanks for tuning in.
Until next time.